Hello and welcome back. We start our series on valuation today by starting with what we refer to as beta. For those of us that are not familiar with what beta means, beta is basically we are trying to look at the relationship of a stock in relation to the broader market, to the overall market. The overall market measures the performance of all the shares. In Nigeria, we have the NGX ASI, the NGX All-Share Index. You have various stocks from different industry, from different sectors into one. It's actually measured the performance of all those stocks. So we look at the changes in price of stock price of that particular stock in relation to the overall market. Your stock, your beta basically is a measure of risk. You use your beta to measure risk. Before we go in depth into how to actually calculate what beta is, the calculation of beta, we have two types of risk. Basically, we have the systematic risk. The systematic risks are those risks that affect the overall economy, the overall markets in general. So they are referred to as undiversifiable risk because every single person is affected from different industry to sectors to different economy. Everyone is actually affected. So you have volatility of exchange rates, you have inflation, you have interest rate volatility, you have tax, and many more to come. So those are examples of systematic risk. Everyone is affected by systematic risk. We have what is called unsystematic risk, which is called unique risk because it is actually particular to a company in itself. It is diversifiable. It's actually particular to a company in itself. So you can actually reduce your unsystematic risk by diversifying your portfolio, your holdings, by mixing your stock from different industry and sectors. Maybe you have stocks from FMCG, from telecommunications, from oil and gas, from insurance, from pension, actually to make up that particular portfolio, different stocks from different industry and sectors to make up that particular portfolio. That's how you can diversify away from unsystematic risk. Let's go back to our systematic risk, which is what we are concerned with. Your systematic risk is measured by what we call beta. Remember, I said beta, you are looking at the volatility or changes in the stock price in relation to the broader market. So we have a formula here, how to calculate beta using a real life scenario. We're going to be looking at how to calculate it by using Zenith stock price in relation to the NGX All-Share Index. So we have the covariance of RI. Your RI basically standing for the stock price of the company itself, which is in this case we have Zenith. Then we have the RM, which is the returns of the broader market. In this case, the NGX ASI All-Share Index. So over the variance, we look at it in relation to the variance of the returns of the broader market itself. So that's how to calculate better. So we'll move on to our Excel to actually see how this is computed. But beforehand, you are going to be looking at a website in which you can download the returns, the historical data of both the stock price and the overall market, the all-share index. So you are going to be going to investing.com. I have this open already, so you can just type in investing.com in your browser. So I'm going to type in the ticker of the company, which is Zenith Bank. So we have Zenith Bank PLC. So I'm just going to click on this. So we have the interface of this. We have Zenith Bank PLC. What we're concerned with basically is the historical data, the historical share price of the company. So I'm clicking on historical data. So we have the period. So we have the period to use for our stock price. So I'm just going to be sticking with 1 year for this illustration, basically. So I'm just going to go down to the calendar, down to 2025. We can use 2025 example, or you can just use the year to date, which is from 2026 January to June as of the current period of making this video. So we have for 2025, we have January 1 down to 2025 December 2025. Then we have December. Then I have 31st. Yeah. Then I have apply. So we have these dates here. So I can just click on download to download the actual stock prices. I have it downloaded already. So I'm not going to click on download. So we go on to the second one. Remember, the formula is covariance of RI, which is your stock price. This case Zenith in relation to your RM, which is the returns of the overall broader market, your ASI. So we have the NGX ASI the NGX index. Yes, the all-share index. Remember, I said the overall market, not all these. Yeah, these are for a particular industry. So I'm just going to be sticking with the all-share index. I'm giving it a minute. We have the all-share index. Same thing. We are only interested in the historical data set. So I'm going to filter this down to the same period as we have done for Zenith Bank. So I'm just going to click on the calendar, move down to 2025, January 1st, yeah, down to 2025 for December 2025 or 31st December. Then I have apply. So I'll give it a minute to apply. Yeah, it was applied, then I click on download. But I've done this already. I have my all-share index and I have my Zenith Bank history prices, historical prices. So I'm just going to click on both to have it open. Okay, so I'm going to do the same thing for the banking one also. So I have this open also. So I've combined both into one workbook. So I have Zenith Bank stock price and all share index historical data. Now what comes out with basically is how to calculate beta, which is the covariance of the assets, which is in time Zenith Bank in relation to the returns of the markets, in relation to the variance of the returns of the markets also. So what I need basically is the change in the stock prices. This is the date. So I'm just going to select this as HOI to make that to be broad. So I have the change for Zenith Bank stock price, and I also have the change for the all share index. I'm just going to do Control A Alt HOI alongside this. So I have the change also. So what I need basically, so we're going to be calculating our beta, which is equals to covariance. So we have covariances here. We have the one for P and the one for S. We have the one for population and the S standing for the sample. So the Zenith Bank has been listed for a while now, but we only took for 1 year data sets. We only took a data set of 1 year period. So that is a sample out of just the total population. We only took a sample of 1 year. So I'm just going to be sticking with the one for S, which is the sample. So our first array, remember our formula. Our formula is basically the returns of the assets in relation to the returns of the market. So I'm just going to stick with the return of the assets first, which is stock price of Zenith Bank. Go down to the returns, which is the changes, control shift down, then comma. Then move down to the second parameter, which is second array. The all share index, the changes there, control shift down key, then I have enter. So I have this as covariance. So now we're going to do the variance of the asset itself. The variance of the market itself. So we have a cost variance. So same thing, we stick with sample, then the changes, the returns on the market, then enter. So we have this for the covariance and the variance. So our beta basically, our beta is equals to the covariance divided by the variance. So we have a beta of 1.55 approximately, 1.55 approximately. So what does this mean basically? So we've calculated our beta to be 1.55 approximately. But what does this beta actually mean? So if the beta, remember I said the beta is the relationship of the stock price in relation to the overall broader markets. So we are trying to check the risk or the volatility of that stock price. So if it is equals to 1, it means the stock prices are just as risky as the market. Meaning if this general market, the broader market moves up by 10%, the stock price will also move up by 10%. If it goes down by 10%, same thing applies to the stock price. But if I have a beta that is greater than 1, it means the stock prices are riskier than the market. If the stock price goes down by, the broader market goes down by 10%, you are going to have the stock price going down maybe by 12%, 15%, much more higher than the overall market. Same thing applies when this is less than 1%. When this is less than 1, rather. If it is less than 1, it means the stock price, the volatility of that stock price, it is less than the market. The risk is actually less than the broader market. Then we have a situation when it is equal to 0. If you have a situation when the beta is equal to 0, it means there's no correlation with the broader market. Thank you. That will be all for beta. We'll miss in the next video.